Welcome back. Today we're going to continue our series on fundamental investing terms and definitions by taking a look at the price to book ratio. Calculating the price to book ratio is pretty straightforward, like it was for price to earnings. You take the price of a company or its market cap and you divide it by the company's book value. You can do this on a per share basis by taking the share price of the company and dividing it by the book value per share. Now, this leads us to four important questions we need to discuss. How do you calculate a company's book value? Is there a way to look up the price to book ratio? When to use price to book instead of price to earnings? And what is considered a good price to book ratio? Let's start off by answering the question, how do you calculate the book value of a company? You start by adding up all of a company's assets. This includes cash, cash equivalent, land, building, investments, receivables, vehicles, intangible assets such as intellectual property. Next, tally all of the liabilities, which can include loans, accounts payable, mortgage, deferred revenue, bonds, warranties, and legal fees. Then, take the total assets, subtract the total liabilities to get the book value. You can do this on you can calculate the per share book value by taking the book value and dividing it by the total number of shares. Now let's take a look at where you can look up the price to book value online. Go on to Analysis, Annual, and I scroll down until I find Valuation, and I can look up the price to book ratio for 2022 is 0.99. If MSN isn't your cup of tea, you can go to Google Finance, type in the company name or ticker symbol, scroll down until you find the, balance sheet, set to annual, and I will find the price to book ratio is 1.02. Or you can go to my favorite website, which is Seeking Alpha, look up the company, go to valuation and scroll down. You can find the trailing 12 months price to book ratio or the projected 12-month price to book ratio, which is 0.98 and 0.94 respectively. Now, I do want to point out something, and that is depending on which website you go to, sometimes they'll report over different time frames or they'll use different metrics for determining the price to book ratio. It's important when you're evaluating one company versus another company to make sure you stay consistent with a particular website that uses the same metrics every single time. Moving on to our third question, when to use the price to book as compared to the price to earnings. The short answer to that question is that you use both. Understanding a company's financial health cannot be done with just one tool. The more tools you use, the better your understanding will be. In particular, you want to pay attention to a company's price to book value when that company's earnings are tied to something that tends to fluctuate, such as an investment bank, earnings are tied to the stock market, or an oil refining where earnings are tied to the price of oil. When the price to book is used in conjunction with the price to earnings, you can spot a company that has potential financial red flags. For example, if a company has a good price to earnings but a high price to book, that may indicate that the company has a lot of debt. Now let's tackle the last question. What is a good price to book ratio? Now, to help answer that question, I've gone to finviz.com and pulled up the price to book heat map. Now, if you look at technology, communication services, and customer cyclical, you can see that they tend to have higher price to book ratios, particularly when compared to finance, utility, and energy. And the reason is because finance, utility, and energy all require a lot of capital to start up and to expand their businesses, which tend to drive down the price to book ratio. In my opinion, the best use of the price to book ratio is by comparing companies in the same sector and, if possible, in the same industry. For example, if we take a look at ExxonMobil, we can see that over the last year, it's done very well with a stock price appreciation of over 21%. However, if we go to the valuation tab and scroll down, we can see that the trailing 12 months price to book ratio is 2.23, which is over 31% higher than the sector average. In comparison, if we go to Shell, Shell has also had a fantastic growth this year. And if we go to the valuation, scroll down to the price to book ratio for the trailing 12 months, we can see that it has 1.08, which is over 36% less than the sector price to book ratio. So in my opinion, if I was interested in buying a company in the energy sector, I would look at Shell before I would look at Exxon, because I think Exxon is going to be a bit overvalued and Shell is going to be a bit undervalued. Well, I hope you found today's video educational, if not entertaining. If you have any questions, please leave them in the comments below. And remember, have a great day and keep investing.